Hello, Verse clients. Today I am joined by Tom Schubert, who is the co-founder and CEO of Drummond Capital Partners, again for our quarterly investment update. Thanks for coming and joining us today, Tom.
Thanks for having me, Ellie. Good to chat again.
Yeah, always great to chat with you. Always lots to talk about. Last time we met, it was May. We just come off Liberation Day.
Yeah.
It's been a lot that's happened in markets since then. A lot we've seen, big noise in the media as well. Can you give us a bit of a brief recap on where we're at now, post May?
It's been quite the pivot in terms of markets, and there's been a nice little acronym given to Donald Trump, TACO. Trump always chickens out. But then if you refer to his earliest book, The Art of the Deal, perhaps I think it's more of the latter. So we had Liberation Day, as you alluded to, in April, which was a really upsized tariff policy that was announced versus expectations, and it caused a lot of volatility in markets. And subsequently, Trump, supposedly was chickening out and walking those back. He was deferring them for 30 days, 60 days, 90 days, so on. Then discovered that it's really difficult to do 200 plus individual trade deals in 3 months. Normally these things take a long time, and they do. And so subsequently he's come out and given up and just started announcing what the trade deal will be. And most countries actually have rolled over and accepted them largely. And so what's really interesting is markets sort of went, oh, it's not going to be as bad as anticipated, ignore the noise, and have marched higher and recovered all their losses and some. Whereas actually the tariffs that have been finalised and announced are equivalent to 17% of trade, up from 3% at the start of the year, and almost as bad as they were on Liberation Day. So he's kind of somehow managed to wave his hands and get the desired outcome more out of the deal than TACO, it seems. And so now we're sort of going through the process of those tariffs being implemented, and that's really going to be the next few months will determine. We're starting to see the economy slow a little bit, but that's negative on the earnings front. But on the positive side, that means interest rate cuts. So we saw one coming through in Australia recently, and on Friday night the US announcing that they're probably going to have a cut coming through in September. So that's a positive from a market's point of view. And so we've seen really strong recovery right across the board. But what has been interesting is from early this year, when they started announcing the tariffs, there was a big trend to want to diversify away from the US. So we saw a lot of sell US stocks, sell the US dollar, and buy other markets in other regions. But actually what's come out in the last few months is just how good US companies are and continue to be. And we've actually seen investors flock back quite quickly into those large cap tech names. The earnings coming from Amazon and Microsoft and Nvidia continue to be absolute leaders in the market, and that's really what's taken us to highs again.
So thinking about where we're at in markets now, Tom, a couple of my teammates had some questions for you, and one of them was around return expectations for the next 10 years.
Yes.
I know that as a team, you guys have sort of completed your strategic asset allocation review. Can you take us through what you guys as a team are thinking in terms of asset allocation and return expectations ahead?
For sure. Can I share one slide with you, please? Because it will help.
Please do. I think our clients would love to see some slides. And who doesn't love a graph?
Who doesn't love a graph? So each year, over a few months, we sit back because there's obviously noise. We manage portfolios tactically, like shorter term around, on a month-to-month basis. But really what drives long-term returns is asset allocation and getting that mix of assets in your portfolios right over the long term. And so we spend a lot of time thinking deeply about the future, bit of crystal ball glazing. But because we don't know, we take a scenario-based approach to asset allocation. So we try and think over the next 10 years, what are the possible paths that the global economy is likely to take? And what does that mean for asset class returns and indeed risk? And so we're thinking over that 10-year horizon, what are the big themes that are potentially going to unfold? Things like AI. And what does that actually mean for the economy? What does it mean for earnings? We introduced the idea of the AI economy in last year's review. But this year, what we've done is actually embedded some of that across every possible scenario, i.e. we believe that AI will make a positive contribution to economic growth and therefore earnings over the next 10 years. And if you look around, you read the papers, you read corporate announcements, everyone is finding a way to embed it into their business to become more efficient. So we think it's real, and we think there will be some benefit from that over the next 10 years. Other things that continue to shape the outlook are an increase in defence spending, deglobalisation, so shifting supply chains, particularly now Trump's announced all of the trade policy. A good way to get off the tariff that he announces is to announce a big investment in building a factory in the US to build something, and then you'll give you a more favourable deal. That's sort of deglobalisation rather than, have a factory producing goods at a lower cost in China. You now have to go and spend money on building a factory and using more expensive US labour, for example. And so there's a bit of that trend driving, capital expenditure, if you will, alongside more capital expenditure and defence spending. And indeed, decarbonisation, still a big shift, even though it comes and goes in terms of its focus for politicians. There is a real strong trend towards building more clean energy infrastructure around the world. Those things are somewhat inflationary in that it's requiring a lot of spending and investment. But the good, the sort of good side of that is we think it keeps interest rates at a more normal level. The return to the post-financial crisis, times of zero interest rates, we're not going back there. They're well in the past. And so from a total portfolio perspective, we think we get reasonably good returns from defensive assets, such as, corporate debt or credit, which is these blue bars here. Australian credit, we forecast over the 10-year horizon to give us 6.3% per annum. That's pretty low risk. That's a good low risk return over a 10-year horizon. That's a function of interest rates remaining at a more normal level. Government bond returns are a bit more patchy. One, the governments are spending more than they generate in revenues. We know that's a problem here in Australia. It is in many countries around the world, and so that affects the return from bonds. The green bars are showing the 10-year returns from equity markets. These are annualised over a 10-year horizon. They're just the baseline asset classes. They're not a straight line. You don't get that every year. There's a path around equity returns, as we all know, but it does give us some indication on what we can expect over the long term. And so we look at MSCI, that's the world, and it's forecast as 7.7% per annum over 10 years. So that gives us an idea. The long-term average return from global equities is about 9%. So we're slightly below, about 1.3% below the average return over the next 10 years. And that is a function of starting valuations. Equity markets in Australia are trading above their long-term average. Equity markets in the US are trading above their long-term average. Indeed, 20 to 30% above their long-term average. And that means we should expect returns to be slightly lower in the future than they have been in the past.
So if we should be considering that we're sort of tapering our return expectations, what opportunities do you see and risks also globally at the moment and for the period ahead?
That's a great question. So opportunities, we still continue to see over the long term, equity prices follow earnings essentially. And so we are still able within equity markets to find pockets of value. So a recent addition, like large cap Australian shares look pretty expensive and don't have a lot of earnings growth. They're dominated by the big banks, which aren't growing very strongly from an earnings point of view. But if we look further down into smaller companies, there's some interesting smaller mining companies that are, producing the minerals we need for batteries, for example, or there's higher growth technology companies that are sort of generating better returns. So we've added a small cap Australian equity allocation. So within the asset class, we're able to find parts of the market that are either better value or have better earnings growth. So that should help boost returns. That's one opportunity. In global equities, it's still very much dominated by the AI theme and technology and which companies are going to be the winner. We sort of get that exposure through, either owning US equities through the index or through specialist managers that are focused on that segment of the market. Other things like infrastructure, look, it says 6.5%. We think that's conservative in a way. We own some infrastructure. It's an overweight position in portfolios. It's actually starting to see some real benefit from the AI boom. So big tech companies are building big data centers, and big data centers need more power. And so one of the beneficiaries of the AI boom is actually the more boring sector being infrastructure. And so we go, we can get 6% yield and some growth from infrastructure and get some sort of exposure still to AI through that theme. So there's different ways to play those opportunities as well.
There's still opportunities ahead. It's just previously we probably looked at large caps providing a lot of contribution to return, but maybe we're looking at other asset classes for the period ahead.
Exactly. We'll just have to be a bit more selective and looking within the asset classes and just mindful of buying the aggregate market and what return you're going to get, I guess.
Last question, Tom. We were just talking about this before we hit record, but we've had a lot of volatility in markets over the last, say, 3 to 6 months. And clients are naturally always worried about volatility. But we're talking about diversification and why that's important in portfolios. So even though we've got this period ahead where we might be tapering return expectations, from a diversification perspective, do you still think that's the core to returns overall?
Yeah, diversification is key. And actually, when we look across the spread here, the difference between good defensive returns and good growth returns, it's a bit flatter. So in some ways, if you can get 6.3 from defensive Australian credit versus 7.1 for Aussie equities, and now there's some nuance in there, small caps versus large. The reality is, having a defensive anchor of income at 6.3 is pretty attractive from a total portfolio perspective. And overall income levels are running at about 5% across the portfolios, give or take a little bit, depending on the risk profile. That's a really good starting point. Not that long ago when we were in that zero rate world, you didn't get paid anything. Your starting point was zero each year. And so growth had to do a lot of heavy lifting to give you a good return. Whereas now we're in a world where you get 5% when you start, and really then growth has only got to give you an extra 3, 4 or 5 over the year, and you've got a really healthy return that's kind of consistent with the long term in those portfolios. And so that diversification piece that helps deliver that income is a great starting point for portfolios.
So really important to look at income as a core contributor to return overall in the portfolios.
Absolutely.
Excellent. Well, thanks for joining us again, Tom. We really appreciate it as always, and we look forward to seeing you in a couple of months' time.
Thanks, Ellie. See you then.